Hey, soldiers, warning, your taxes, your income taxes are about to increase. That's right, we've been talking about it on the channel now for a little while. We are facing the end or the sunsetting of the Trump tax cuts. He signed those in 2017. And remember, Congress said as a concession, yeah, you can go ahead and make these corporate tax cuts permanent. However, the individual tax cuts have a sunset December 31st, 2025. So, January 1st, 2026, which is not that long from now, it'll be upon you before you know it. That first dollar you make, well, the government could quite conceivably be entitled to what? A whole 39.6% of that, depending on your tax bracket. So, let's go over it, figure out what's going on. We're also going to tell you what you need to do now. All right, I'm going to make some suggestions here for you to use the tax code to your advantage before we go over into this new taxation regime. Now, it is possible that whoever becomes president in November of 2024 will fight to maintain these tax cuts, maybe even cut more. But then it is also possible that if certain other people become president, they might say, well, look, we're doing a lot in Eastern Europe. We've got a lot of new Americans that need all kinds of, services that cost money. And we got to pay for it. So tax-paying citizen, taxes are going to go up even further. Okay. Now, the reason that you don't hear any candidates talking about tax increases right now, even though we're in the midst of a presidential election season, is because we've got the Trump tax cuts, which are set to expire. So that's an automatic tax increase. They don't have to talk about them. Now, we're going to go over a little bit of this. We're going to get to what you may want to do. And we're also going to tell you exactly how much your taxes are going to go up by. You're going to be shocked and amazed. Trump era tax cuts are set to expire. Here's how much you'll pay. When 2025 draws to a close, so will many of the sweeping Trump era GOP tax breaks established by the Tax Cuts and Jobs Act of 2017. A lot of people use the short form Trump tax cuts, but that's the official name of it. While the legislation made some tax cuts to corporate profits permanent, and look, when you think corporate profits, don't necessarily think Fortune 500. Again, one of the ways to legally tax advantage yourself is to have a business that's out there selling a product or service and, creating opportunity. The government does have tax breaks for that, as evidenced by some of these corporate tax cuts from the Act of 2017 being permanent. Now, it also lowered individual tax rates, as we discussed. That's coming up for expiration. Largely dependent on which party ends up controlling the White House and Congress after Inauguration Day 2025, changes to the tax code are coming. So they're either going to not do anything at all, which would raise your taxes. They're going to raise them even higher, or they're going to lower them. Something is bound to happen. And two of those eventualities, two of those potentialities mean more money out of your pocket. And when we take more money out of your pocket for taxes, that means there are fewer assets that you can afford to buy. That's why we've got to use the tax code, the law, to our advantage. Hey, Congress certainly does. They write these laws, okay? So they advantage themselves. Whether cuts can be kept by Republicans, rates rewritten by Democrats, or a divided government will agree on some sort of bipartisan compromise, taxpayers of every political persuasion will be affected. In an editorial on Real Clear Politics, Julio Gonzalez, the CEO and founder of Engineered Tax Services Incorporated, warns of a, quote, harsh reality, unquote, facing Congress. Quote, we are in a situation in which many American families and businesses are hanging on by a thread. Don't we know it? And I'm going to interrupt his quote for just 1 second because, look, when taxes go up, I don't see inflation going down. We talk about that all the time, right? What item costs less today than it did 10 years ago? So you got inflation that's been on a tear since 2020, since shortly after 2020, 2021, let's say. Inflation's been out of control. We got rising interest rates, and we got the specter of increases in taxation. You've got to watch this channel. You've got to share this information with your friends and family, because we talk about mitigating the realities of inflation, higher interest rates, and taxes. And we also, like we're going to do in a minute or so, talk about how to use these situations and advantage yourself. Let's get back to Mr. Gonzalez's quote, letting the non-permanent provisions of the Trump era tax cuts expire could be catastrophic to our overall economy and well-being of many working families. All right, now let's get into how much your taxes are going to be increasing. Although it kept 7 income brackets, the tax reduction legislation lowered tax rates across the board and restructured bracket spans, making them more agreeable under the act, with the exception of those who were at 10%, okay, those making $11,000 or less, and 35%, those earning $231,000 to $578,000. Tax rate levels prior to 2018, all income tax rates decreased when the new laws came into effect. So the poorest and the absolute, highest income earners out there, they were left alone, okay? But everybody in between, we saw some sort of manipulation. All right, so let's get into this. The top individual tax rate dropped from 39.6% to 37% under the terms of the Tax Cuts and Jobs Act. That's single filers making $578,126 and over, okay? So actually, that is the highest bracket. That one we talked about earlier, the 35% bracket, is just beneath that. So they're going from 37% under the Trump tax cuts to 39.6%. And I know what you're thinking, and I'm going to get to that in a minute. You're thinking, Tyrone, come on, man, it's only 2.6%. It's a lot more than that. The 33% bracket fell to 32%. The 28% bracket fell under the Trump tax cuts to 24%. The 25% bracket went to 22%, and the 15% bracket went to 12%. And you're saying, oh man, I thought you were going to really tell me about some stuff that was really, onerous and burdensome. Well, do the math. Because while these rates have dropped a few points, the actual percentage increases that we're going to see in 2025 are as follows. So for that 12% bracket, those folk that are only getting hit with 12%, okay? Now, mind you, they are individuals who make between $11,001 and $44,725. Okay, so you could say this is the working poor. So the working poor is going to go from 12% to 15%. That represents a 25% increase, okay? That's not a 3% increase. It moves by 3 percentage points, but that represents a 25% increase on the taxes that the working poor will pay once these Trump tax cuts expire. Those who go from 22 to 25%, that's a 13.6% increase. The 24% bracket right now is going to 28%. That's a 16.6% increase. The 32% bracket's going up to 33%. That's a 3.1% increase. And those who are currently paying 37% are going to pay 39.6%, and that's a 7.2% increase. So what can you do? Well, you need to, and you've got a year, right? Roughly a year and a couple of months, because I'm recording this on October 11th of 2023. So you need to take a serious look at those vehicles that are going to either allow you to bring down your taxable income now So we're talking about the qualified plans, your traditional IRA, your 401k, because you need to work the strategy in a dual fashion. That's just what I would do. You do what you want to do, but this is just food for thought. So with the qualified plans, you got the opportunity to reduce your taxable income. Now, depends on how much you're making, how much your company matches. If they do, there's some variables in there that will tailor the situation for you. You need to go ahead and talk to your 401k provider at your job, or your accountant, CPA, or whoever handles your money. So you need to work that side, take a look at that. And then you also need to recognize the fact that, as I always say, taxes are not going down. Again, we got $33 trillion of debt, not counting the unfunded liabilities. Your share right now as a taxpayer is $258,000. It's going up from there. So you need a bucket of money that is going to allow you to dip into that when you need it, as long as there's money there. And that money, after you put it in, because you've already paid taxes on it before you put it into an insurance policy, a permanent insurance policy, like a whole life policy or a index universal life policy, okay? A Roth IRA is also going to assist you with building that bucket of money that has been taxed at what we think are the lower rates today, so that when the rates are higher, you'll have a nest egg that is not impacted by that. So that's what's going on, folks. Take a look at this video right here. We walked you through another aspect of this evolving economy and how you may want to think about advantaging yourself in it. Guys, I'll talk to you soon.